Welcome to Thought Leaders, featuring interviews with some of the best minds in the industry. Today's special guest is certified financial planner and registered investment advisor, Rob Odell. Hello everyone, I'm Steve Savant, syndicated financial columnist and talk show host. In this segment, we're talking about consumer tax planning for clients and prospects for end-of-the-year tax planning. We'll touch on the current tax system, the tax diversification strategies, and tax arbitrage, all from Rob's popular Mind Map seminar series. Well, when we're talking about consumers, we as advisors, we talk about a lot of heady stuff, MBA language. Yeah. But what we're going to do now for the next two sessions is talk about a redux of all the things we want to do in tax planning, but in normal everyday language.
Right.
So let's walk through that. What's your first thing? You're a registered investment advisor. You have a retail and client in front of you. Talk to me about this.
Well, I find that most advisors ignore the taxes. The biggest disconnect I see in financial planning day is that people who are advising on insurances and on investments are disconnected with the tax planners. And if you can integrate the both, the client will win. And so when we sit and talk with clients, we like to educate them in basic English, but what we find is if we can save them money on income taxes, it's like sugar. They want our services. They really do. The 2012, last big tax act in 2012 broke it into seven categories, seven brackets, if you will, for those filing tax returns. First thing we do is we look at where the client is at in their taxable income, not their adjusted gross income, but their taxable income. And typically for a client, let's say who's in the 25% bracket, we like to look at that because when you go in the 28% bracket, the marriage penalty comes back into play. And so if we sit down and work with clients and say, all right, what are the various phase outs that they have, look at their tax plan and engineer that tax return for them.
So if I start getting up there in that 28% tax bracket, I may think about filing separately, not joint file. Is that correct,
Right.
what I just heard?
Right, and in today's tax code is so complicated. There's all these moving parts because you're looking at adjusted gross income, modified adjusted gross income, taxable income, and then you have alternative minimum tax. Very, very complicated. But we advisors can break it down and make it simple and demonstrate to the client that we understand that this very complicated thing for them, but explain it in basic English to them. You'll have clients coming to you.
And really, understanding the basics of tax code has really won you several clients. And really, you're a registered investment advisor. You love assets under management, but this is the entree into it.
Right, exactly, because they'll listen to you.
Yeah.
I had one client that realized a bunch of capital gain the previous year before they hired us with their former advisor. They said, we need to buy a house, and they sold a bunch of capital gain property, stocks that is, and they had a huge capital gain. Whereas if they would have done some planning, chances are we could have minimized that, maybe even eliminated the capital gains.
Wow.
And I demonstrated for that, and they became a client. There's a big difference between tax planning and tax preparing. And not to pick on people in the CPA and tax accounting profession, but most of them are scorekeepers. They're looking backwards. But if you can find a tax planner, or you yourself become one, where you can start looking forward and start talking to clients about what the 2015 tax return is going to look like, what their 2016, their 17, you will have clients coming to you and being referred to you by other advisors.
Now, does it surprise you, you've been in this business a long time, that the CPA community at large are great fiduciaries, but they're not very proactive?
Right. And another thing I found is with the CPAs, I like the CPA, working with CPAs. I'm not replacing the CPA. I'm working with them in concert. And that's another thing that you need to understand and people need to understand. So we're not trying to be one up on them. We're trying to work in concert to give the client the very best result.
Okay.
Let's talk about tax diversification. So much, especially in the RIA community, it's all about investment diversification. I think there needs to be more time spent on tax diversification. And what I mean by that is that you have tax efficient assets and you have tax inefficient assets that are out there. So tax efficient assets are index funds, which usually don't have a lot of capital gain kicked out. Municipal bonds, everybody knows they're tax free, but there could be some bite to that, as we talked about in the previous shows. Life insurance and immediate tax cash values and immediate annuities, these are all things that are tax favorable. Tax inefficient would be a high portfolio turnover. So if you have a client whose money manager is buying stocks and taking gains and not really looking at the tax consequence, they will get hit at the end of the year. Mutual funds are guilty of that. And high yield bonds, and some people, high yield bonds are junk bonds. They pay an interest rate of 5, 6, 7% in today's world, but usually it's all taxable to the individual. And then covered calls, which is some strategies that produces short-term capital gain. And so we as advisors should be looking at what account should I put my tax-efficient assets in, meaning the titling of the account, should it be an after-tax account or a tax-deferred account like an IRA? You'd want to place the tax-inefficient assets into the tax-deferred accounts. You can control the taxes here. leaving the tax efficient outside into taxable after-tax accounts.
Okay, so when I'm approaching this, even if I'm a registered investment advisor watching the show, I'm so used to the management and the allocation of my clients' investments, but maybe I'm not up to snuff on the actual taxable consequences of my trading.
Correct.
I mean, this could be an issue.
Correct. For instance, I have a client, a very high-capacity client down in Naples, Florida. They somehow found 2% CDs they're paying interest, and they like the stability and they like the interest rate there. Now, I'm a fee-only financial planner. I do not sell products. I advise on them, but I do not sell them. We actually reallocated those CDs to a single premium whole life that was paying 3.5%. So they're able to get almost double the return, but they were not paying tax on the interest as it was earned in a year.
Well, for more information on the current tax system, tax diversification, and tax arbitrage, just click on the landing page address in the video description. We'll be right back with more from Rob O'Dell.
A solid web presence has never been more important to the success of your business. Introducing Agent Website Creator, provided by CreativeOne. Through Agent Website Creator, you can create your own personalized website and have it up and running easily with zero knowledge of programming. Choose from several designs with easy drag and drop customization. Get proven lead generation offers, professionally written articles, and helpful financial calculators. Plus, the ability to embed videos, integrate your social media, and more. Update your website anytime and show the world within minutes. The best part? It's hosted for free. To learn more about Agent Website Creator, call your CreativeOne sales team at 800-992-2642 or visit us online at creativeone.com.
In this segment, we're talking about Social Security and the tax arbitrage for end-of-the-year planning for our clients. Specifically, on these two subjects, we're pulling it all from Rob's popular Mind Map seminar series. Well, let's talk about this. We touched, before we get into Social Security, I just want to touch a little bit on that tax arbitrage,
Right.
because when I'm a client, client goes, what's an arbitrage?
Right. Well, I don't say arbitrage ever to a client.
Yeah,
I
right.
never use that word there. But just as an advisor, so if you have clients, and maybe we'll say 250,000 is maybe that point. And so if you have clients who are making more than 250,000, high income earners, as advisors, we're seeking to avoid and defer taxes for them. And so that might be retirement plan contributions, which we talked about in our previous shows. It might be charitable gifts, which we're going to be talking about next week, as well as we talked a little bit past, and tax loss selling. These are ways in which they can reduce their income tax liability for the current year. Now, for the lower brackets, for those in maybe the 25% bracket, you might be looking at Roth conversions, a way in which to generate a little bit more taxable income, and they can absorb it, and so they'll have future better tax benefits. And gain harvesting. So it really depends where they're at. So we as advisors, if we can sit down and figure out what's the best for the client, maybe confer with their CPA and then explain it to the client, you'll have clients for life.
So I could harvest gains and losses on funds.
Right.
I could go ahead and maybe say, hey, I got a little room on my bracket.
Right.
I convert some of my qualified monies to Roth monies.
Correct.
So there's a lot of things to do right now.
Correct. And then this plays right into Social Security planning, because clients who are now in Social Security and they're at full retirement age and they're taking money from Social Security, the taxation on Social Security varies, and there's different bars you look at. So for single people who make less than $25,000, there's no tax. And between 25 and 34, 50% of the benefit is taxed, and above 34, 85% is taxed. And for married couples, a little bit of a marriage penalty here. Under 32,000, non-taxable. 32 to 44, 50% taxable, and 44,000, 85% is taxable of their benefit. And for lesser income people, this is very, very meaningful.
Well, I could just think of the loss of the first spouse, which would put you in your single payer, which is almost a stealth tax on seniors, just because the marriage, now you're pushed back to the single payer. That's another extra tax.
Exactly. It
Unreal.
It is. So let's talk about some strategies that advisors can look at to reduce a client's income taxes on their Social Security benefit. Number one is muni bonds. If they have municipal bonds, your clients, and they're getting interest because they want tax-free savings, interest on muni bonds is factored into the equation for their income and is added to that the 32,000 or the 44,000 they looked at. An advisor might consider looking at a single premium immediate annuity combined with a life insurance policy to replace that money that goes there to the next generation. Why? Because it's tax-favored income. The exclusion ratio gives them, the majority of it is tax-free return to principal, and potentially a higher income as well. So there's a double win there. They might look at tax-deferred investments. Like I made the example I gave my client who has those CDs and did a single premium whole life. That's a great way in which they can defer income. And finally, this is really big, especially for people who have a large percentage of their income in Social Security and they're charitably inclined. if they're over 70 and a half and they write the check directly from the IRA to the charitable organizations, that income, the required minimum distribution, does not show up on their 1040 at all. It's an above-the-line deduction, thereby saving them on Social Security.
So I just want to make sure I have this in order. So if I'm charitably inclined,
Right.
and I have a IRA, and I was going to give money to them anyways,
Right.
and I really don't need it for my own personal income, this is a huge opportunity.
Right.
Now, is this something that most people don't know, and now you're bringing that to them as the RIA?
Correct. Now, there's a little caveat here for 2015. This is not official for 2015.
We think they're going to do it.
We think they're going to do it. They wait until the 11th hour of every year and they pass it through. You thought they would have put it through. The recent legislation was passed a few weeks ago. It was not in there, but most people in Washington, most advisors believe that this will happen for this year. So what is an advisor to do? If you have someone who's charitably inclined, they have an IRA, they're over 70 and a half, have them write checks directly from that IRA to the charitable organization. Make sure the charitable organization cashes it before 12/31. If it's passed, great. If not, they'll get a Schedule A deduction. It may adversely affect their Social Security, but it's no different than if they would have given
Now,
after-tax cash.
a lot of clients, they're trying to maximize their Social Security. They're trying to stall from their, not take it early at 62. That's a 25% discount immediately off your premium. So in my age group, we're going at full retirement age for me is 66.
Right.
Okay. And I'm thinking, hey, it's only 4 more years, and we're looking at 8% simple compounded to get to age 70.
Correct.
That's a 132% markup.
Yeah.
So I'm trying to always encourage our clients to go ahead and try to forestall this,
Right,
if they can.
If they have longevity in their life, if we know there's some conditions that they may not make age 81 or 82, which is kind of the crossover rate, if you will, stalling it makes a lot of sense.
Okay, so we may have other areas here to go ahead and try to change our RMDs, because that's all going to impact Social Security, right? I mean, that's all coming in. We can only go so far, but there are so many avenues here.
So many
when I'm
things.
looking, and our game is, can I keep it off the Social Security provisional income test?
Right.
That's the game.
That's it.
And it is a game, isn't it?
It is a game, but it's but if you can demonstrate it to a client, you say, here's what I can do for you, and they can see the savings. And it's all, black and white stuff we're doing for them. Again, you'll have clients for life.
Think about it. It's always about net spendable income. Net, net, net. For more information on Social Security benefits and taxation for the end of the year planning for consumers, just go to our landing page address and click on it on our video description. And for more information on all our shows, seminars, workshops, just follow us out on social media or visit us out on our website. I'm Steve Savant. We'll see you next time on Thought Leaders. And remember, keep thinking outside the box.